Do you have a small trading account and are you looking for a consistent strategy to trade so you can grow your account? Well, you're in the right place because in this video, I'm going to show you an easy to follow strategy that's perfect for small accounts, even if you have less than $500 to work with. And we're starting right now. Welcome back to the channel. My name is Eric, and this is the next video in the small account options trading series. And if you're looking to grow your account with consistent option strategies, be sure to subscribe and click that little bell if you want more videos like this one. So today we're going to cover a strategy trading the Dow Jones ETF with the ticker DIA, also known as the diamonds. And as you can see here in the options chain, DIA has weekly options that expire every Friday, and we're going to use these different expirations to our advantage to put the odds in your favor of consistently growing your account. And in just a minute, you'll learn why having multiple expirations like this to choose from is going to help with consistency in your trading. So the strategy we're talking about today is bull call spreads on the diamonds. And in case you don't know, a bull call spread is a bullish position where we would want the stock to move higher or at least not go lower, depending on how we position it. The way we're going to position the spread is that we just really need the stock to drift higher or move higher. And this is why it's important that we have this entry criteria, which is the bullish condition. And that bullish condition that we're going to define here is that the 21 EMA is above the 50 SMA. And the reason I'm using those particular moving averages, versus EMA versus SMA, really is because the research tool that I'm going to use, those are the moving averages. You could use a 21 EMA with a 50 SMA. You could probably use a 21 SMA and a 50 SMA. I don't want to get caught up in the different types of moving averages, but in general, when you have a shorter moving average that is above a longer moving average, that means that the recent price action is bullish and that the prices are averaging up, and that bullish condition is going to be conducive to a bull call spread strategy that we're going to talk to. So first thing, before you do anything, you don't want to get into the trade unless the 21 EMA is above the 50 SMA. So once that bullish condition is met, we're going to be buying an at-the-money call debit spread with about 30 days to expiration. And this is kind of why I brought up how the diamonds has multiple weekly expirations, because sometimes that bullish condition may not happen until like the middle of the month. So to be consistent with our strategy, we're going to try to make the days to expiration, the DTE, as consistent as possible too. It's not always going to be 30 days, but as we saw in the option chain before, there might be something with 33 days and there might be an expiration that has 27 days or something like that. So as long as we're getting close to that 30 days to expiration, this is going to be valid and consistent in our entry mechanism for this type of trade. So we're going to be buying an at-the-money call debit spread with about 30 days to expiration. And if that expiration happens to be a weekly option on in the middle of the month, then so be it. That's what we're going to be trading. So once we've chosen our expiration, now we need to choose the strikes. And the way we're going to do it, because it's at the money, we're going to do one option in the money and one option out of the money. The in the money option, the call option, we're going to be looking to buy a Delta 60 call option, and we'll look at that in the option chain in a minute. And we're going to look to sell a Delta 40 call option, which is out of the money. And that's going to put us right at the money. And by the way, I just did a video on this called Debit Spreads for Beginners, and I go into a lot of detail about that spread. And also there's another video called In-Out Debit Spreads. It's part of that small account trading video series I mentioned before. So be sure and you check that out. That's on the homepage of the YouTube channel. So we're going to be buying an in the money call and selling an out of the money call with about 30 days to expiration, as long as the 21 EMA is above the 50 SMA. Once we're in the trade, there's two exit criteria. The first one is if we make 25% on our debit, then we will close the trade. And what we're going to be looking at, a lot of these trades are going to be $200 in price. And if that's the case, then you would multiply that by 1.25, and that's your 25% gain. The gain is based on the amount that you paid for that debit spread. So the debit spread is, let's say if it was $2, a 25% gain would be $50, and then you would close the trade. The second exit criteria is if it doesn't really go in your favor, we're going to want to close that trade after 15 trading days. This is about 3 weeks. So think about this for a second. If we buy a spread that has about 30 days to expiration and we close 1 week before expiration, in most cases, that's going to help us avoid the max loss if the spread isn't doing what we need it to do. And it doesn't necessarily mean that this is going to be a losing trade. It just means the market has not gone up enough, or maybe it went lower and then it just recovered. This could be a small loss. It could be a small gain, maybe a 5% gain. It could be a bigger loss too if the market, if the market's bullish for a long time and you get in that next trade. At some point when that trend crashes or turns lower, you're going to end up with a losing trade. And we'll look at the win rate and all that stuff in a minute. But essentially, we want to buy this spread with 30 days to expiration, give or take a couple days, and we're going to close it after 15 trading days. The 30 days is calendar days, and the trading days is trading days. So within 3 weeks, you're going to be out of this trade, whether you made money or not. And hopefully you made money. But with either one, after you are out of the trade, you're essentially going to go back to the top of the strategy here and look at the entry criteria. So if the market continues to be bullish, after you close that first trade, you would just simply open a new one with a new expiration and you target that 25% gain. If for some reason the market turned lower and you close the trade after 3 weeks, you would look at the entry criteria again. If the 21 is still above the 50, you're going to get right back in with a new trade. If for some reason the market turns lower, let's say in the COVID crash, which we're going to look at here in a minute, it's pretty cool. But if the market crashes and you have that losing trade, if the 21 crosses below the 50, you're simply just not going to trade this until that bullish condition is met. So it's pretty simple to follow. You want to get into the spread if the market is, and I'm air quoting, bullish. And if the market is not bullish, according to our criteria here, you're simply just going to skip that trade. So let's head over to the option chain and just set one of these up so you can see it, and then we'll look at the performance the last 5 years. All right, so we're back into the option chain, and let's just say that market condition occurs today. I'm going to be having to choose between these two expirations. Do I choose the one with 27 days or do I choose the one with 34 days? Because remember, we're trying to target 30 days to expiration. My personal preference would be to err on the side of more time, because remember, we're going to be closing this trade after 3 weeks or 15 trading days, and I don't want to hang on to it as long as close to expiration. So I'm going to err on the side of slightly more if I have that choice. So we're going to come into the November options chain, and I'm going to look at the delta column, and you can do different strikes. We're just kind of looking at a delta 60-40, but I would be looking to buy the 281 call option. This one between 1055 and 1105, that's about $10.75. It's a lot of money. It's $1,000. But this is why this strategy is good for a small account, because we're not going to spend $1,000 to get in. We're going to buy this option for $1,000, but then we're going to sell this delta 40 for, let's just call it $500, even though it's probably a little bit more. So the difference between these is about $5. It's $500 spread. So if let's do that. I'm going to buy a vertical. We said the delta 40 is the 291, so the 281, and we'll scroll this down to 291, and that puts us at about $5.63. I'm doing this after hours, so some of the bid-ask spread's a little bit weird here, but if this is too much money for you and you want to trade it even smaller, you can cut this down and say, okay, I'm going to buy a delta 55 and sell a 45, so you can narrow the spread here. So let's try that. A delta 55 would be, let's call it the 284. That's going to reduce the price of the option that we're purchasing. So we'll do 284. And then if we bring from delta 40 in, remember we're selling a $500 spread. Well, if we narrow that down to 45, we sell 600, that's going to reduce the cost even more. So you can really customize this to how much you want to spend. I just did a delta 60-40 as an example, but if we say, okay, we're going to sell the 289, let's drop that down. Now the cost of this spread is only going to be $275. And again, you can pull this down even more. If you just want to do a $1 strike spread, let's call it the 285, 286. There we go, 285, 286. You can get this spread for 60 cents. Now, with the exit criteria we talked about being 25% gain, is it worth trading something this small? Maybe not, because if, you probably don't have any commissions on this, but if you do, and you can only make 25% of 58 bucks is, what's that, $14, then it's going to be hard to really grow that account. So I think that's a little bit too narrow, but I think the delta 55, 45 is pretty good, but let's just focus on the delta 60, 40 for now. But again, you can adjust those strikes to fit your account and your risk tolerance. But again, that is a personal decision. All right, so now that we know kind of how to set this up and choose the strikes and choose the expiration, let's head over to the backtest software and see how this performed over various time frames. All right, so we are looking at a 1-year chart from the time of this video of the DIA, and we have the 21 EMA and the 50 SMA on the chart. And I just wanted to kind of put this in the context of, the COVID crash. This was in kind of the late February, March of 2020. And you can see this huge drop. And then ultimately, we've recovered, and, we're, at the time of this video, we're heading into the election. So who knows what's going to happen. But I wanted to put this in context because a lot of times when we talk about trading strategies over time and over 5 years, these little, blips in the market, this is where the concern is a lot from people, especially if you have a small account, or maybe you have a big account and you just don't want to risk that much money, or maybe you're in retirement or something, and you just, you want to avoid the big one, right? So what I wanted to kind of show is, let's just look at the past 1 year from this date. I'm doing this video in mid-October 2020. So in the past year, the Dow Jones is actually, I don't know what the percentage is, but it was here at 261 about a year ago, and now it's trading at 285, right? So technically it's up year over year, but man, what a volatile time. So we had this big crash in there, and then we've moved back up. So the question is, how did this do over this period of time? If you're buying a bullish spread, you're going to have that loser. So is that loser big enough to wipe out all the winners you had? Did it recover? What does that look like for my account? Let's quickly just kind of look at the results. So I actually put in here the delta 55.45 to reduce that cost. But basically, in the past year, there were about 26 trades, and you still had an almost 85% win rate. And if you're spending, $100 and so per spread, I think this is a little bit off. It's probably a little bit more than that. But this made about $600 this year, which is, several times over on your money. But here's what the interesting part is. So let's look at the P&L curve. So even though you were, and I hate this pop-up thing, but even though your P&L was moving up, you can see where the drop happened. It dropped, you lost some of that money, but then ultimately you see the P&L flatline. And what that flatline means is the entry criteria isn't there. The 21 EMA has dropped below the 50 and you were no longer trading. So your account balance for this particular trade, I'm not gonna say your whole account balance, but just maybe what you've allocated for this trade, it's just gonna go flat. And you're going to wait until that bullish condition comes up, and then right at this level, you see the market recovered. It started moving higher. The 21 EMA crossed above, and now you are back in this trade, and you start making money again. And again, it's very choppy. This is a day-to-day kind of P&L, but I think it's pretty good for the past year, given the COVID crash. Can you imagine if you're just trading the long side, and you had that move? So anyway, I thought that was interesting. So that's 1 year. Let's look at 3 years, and we'll go back 5 years, and we'll just kind of, see what this looks like. So I like to put that COVID crash dent in the P&L to kind of put it in context of a longer term strategy. So this is 3 years. The win rate came down a little bit. We're down at 77%, and that's okay. Anything that's 85% where the probability is really high is actually not normal. So 70, something in the 70 percentile is pretty good for a win rate. There were 50, 60 trades or so. And again, trading a couple $100 at a time, you're able to, make about $1,000. It's slow strategy, but let's look at the P&L. where again, you have some big runs, the market flatlines because the moving average crosses below and you stop trading it, and you get back in, and maybe you have a loser and you kind of move back up. And the point is, you're not going to make money every month. You're going to have that losing trade because the market goes up and down. This is a bullish strategy. So when the market turns lower, that last trade that you're in is going to become a loser. But typically over time, when that bullish condition exists, that's telling you the market is moving higher, and your P&L is just going to kind of go up over time. And so I really like to give you what this is a more real scenario about making money. You won't make money every month. There may be a period when 2 months where you don't even take a trade for this strategy. For the long side, because why would you want to be long if the market's moving lower? So this is a relatively, to me, conservative strategy for small accounts. And you can see we have our exit criteria over here, 25% gain, 15 days. So, and by the way, if you want to trade strategies like this with me, I'm going to put some information in the description where you can learn about my trading services. But let me ask you real quick, is this a strategy that you think you can trade on your own? Is there any more information you would like? Please put yes or no in the comments if you can trade this. And if you have any questions, definitely put those there too. And if you like this video, let me know by pressing the like button, and I'll continue to put out research videos like this. I've got another video coming up on small accounts, and I'm going to put that into that playlist that's on the homepage. So thanks for watching, and we'll see you at the next video.